Well, hello, this is Chris McAlpin with Sound Financial Strategies and your host of The Chase. Our goal is to give you excellent economic updates, excellent market news and data, and speak some truth into that as well so that you can reach your financial goals. So our whole goal in this show is we want you to be financially independent. Foremost so, I want you to be able to live without the rat race that our society puts on money, without the financial stress, without the financial worries, without the ups and downs. And hey, we look at a world that just looks like it's going to hell in a handbasket. But that's why we want to look at the financial world through a biblical lens, because God's truth gives us a place to be able to honestly look at truth, to be able to see lies, to be able to see half-truths, to be able to see how this affects us and how this shapes us, and to be able to say, okay, God has blessed you. He's blessed me with a certain amount of resources and a certain amount of opportunities and these relationships, also that they can to shape our lives so that we can live generously. We can enjoy the blessings he's given us, and we can invest in our future. So that's what our shows are about. And so listen, if you like this, remember, subscribe, ring the bell, follow us, listen to us wherever you listen to podcasts. Go find us there. Write us a review. Tell us what you think. Ask us questions. We'd love to talk with you and be able to answer those questions. So we've got all kinds of market explosions going on around us. And the stock market took this big giant nosedive to start the year. And then we get this whipsaw like a slingshot coming straight back up into the end of the quarter. Now, the big question is this the start of a new rally? And are we off to the races? Or is this a bear trap? And to help me answer this, I've got my good friend, Clint Sorenson, the Chief Investment Officer of Wealth Shield, also the lead investment strategist of Sound Financial. And so as we think about this, and as Clint is on the show with me, a financial advisor's job is to sit down with a client and diagnose and determine that client's financial goals and understand their obstacles, understand their desires and their emotions, and shape plans to take action in reaching those financial goals. A portfolio manager's job is to look at the economy, look at the markets, to dive into research and study and shape and build investment models to help that advisor, help that client reach their financial goals. And so today, I'm going to have my financial advisor hat on, and Clint's going to have his portfolio manager hat on, and you're going to see what a real argument and a real conversation is like. Because I am going to ask my good friend questions that you, our clients, ask us. And Clint, how are you, by the way, my man?
I'm great, Chris. Thank you. Thank you for having me.
That's right. And this conversation today would be a little bit different if we were having it last Friday, wouldn't it?
That's right. Could be a little
bit different. After four standard deviation moves in the bond market, craziness like that. So here we go, buddy. Nice little rally this week. We get into a rebalance for all of our clients. We rebalanced yesterday coming into the end of the quarter. You'll see all of those statements coming through, all of those trade notifications coming through email and via snail mail. But now, Clint, my big question just coming straight out of the gate. When the markets go down, my investments go down. But when they come back up, my investments don't feel like they come back up as much. Why?
Yeah, I mean, I think that's a great question. It happens all the time, right? I mean, I think what happens when you have any type of regime change, which is what we're dealing with today. So if you're just to rewind, remember when we talked early on, I think it was late last year, early on this year, talked a lot about, hey, what's this 2022 outlook kind of look like? What are we facing? We talked about the Fed dilemma. Fed dilemma was we were facing a slowing economic environment. And that slowing economic environment was going to involve higher than average inflation, which could possibly stay higher for longer. And that was going to force the Fed to either A, prioritize inflation and kill the economy, or B, prioritize growth and potentially have higher inflation. So you're kind of facing this great pickle. And we talked about the potential pitfalls of that. Well, then you sprinkle in a Russia invasion in Ukraine, further pressure on raw material prices, higher inflation globally, and now a more aggressive Fed, and you've got the perfect recipe for fireworks. So we saw all this kind of materialize. And what was really interesting is this materialized a lot earlier than we thought, because the growth data was not supposed, and it's just math. We're just looking at the data. This is not a prognostication. This is simply year over year math on growth, and in particular, leading economic indicators. And what we saw is we saw this happen when we were looking at the math. It was supposed to happen in the second quarter and really be kind of the back end of the second quarter where we'd really see the bad data. And we thought, hey, that's where the probability suggests we could have a tough market. And so what happened is you got this early rush down. Portfolios were positioned not for a rush down. They did have defensive mechanisms, but the way portfolios work and our portfolios work is we adjust and respond to that information to adjust the portfolio. So you had this quick move down, markets got really oversold. The key ingredient that didn't help was even though we made moves, we raised on January 27th, we started moving a good portion of the fixed income portfolio to cash and cash equivalents. Problem was the whole bond market went down. So you had pretty aggressive, even though that was defensive, you had a pretty aggressive move down in defensive assets. Now, this happens from time to time, and in particular in inflationary regimes, when the whole bond market has to price in the Fed moving aggressive against inflation. Likely, that is just a temporary thing. And so what happens historically is you get a move down in the bond market, right? A shock to the bond market system. It feels like, oh my goodness, everything's kind of moving together. But then you start to get things that kind of find their footing. And typically those defensive assets in a continued move down tend to be the benefactors of that continued movement. So that snapshot view of just looking at it over a quarter, right? That's when you will get those moments from time to time. You'll get those moments of correlation where both stocks and bonds are down, both offensive assets and defensive assets are down, and it happens. And so what I always say in those environments is zoom out. Let's look at the bigger picture. Let's look at where we are. How are we positioned? Are we offensive or defensive?
And that, let's before we zoom out, and because I'm going to ask a question almost for our clients, and we'll say let's go specifically to the models in just a minute. But if I own a bond, and the daily bond price goes down because of market movement, when that bond reaches its par value, I get paid my money back, correct?
That's right.
Right. So shouldn't that be the same type of flow through an ETF as well? Not exactly the same, doesn't report exactly the same, but we should still see the same types of results, even if the bond market sells off, that we should see it come back up by nature of how bonds work. And in the meantime, we are making a bond yield. Isn't that correct?
That's correct.
So you're still confident about what we're seeing in defensive assets on the bond side, right?
Oh, yeah. I mean, in equities too, leadership is still firmly in the defensive camp. You just had one of those moments in time where you had to adjust to a new reality, and it was a fast new reality. And that reality was we've had a punch bowl, right? We've had stimulus. And to remind everybody how massive the stimulus has been, beginning of 2008, it was 890 billion. It's 8.9 trillion today. So that is a lot of fuel for a fire. And we had a fire.
Let's zoom over and take a tangent here. Let me zoom over and take us over here for just a minute for our clients. Because listen, clients, we're going to continue the rest of this interview, and you're going to see it in the remainder of the Chase episode. But this front section was just for you in the client update for April. So I'm talking to just our family and friends right now. The most important thing that I want you to do with us over this year, because we're seeing some data that could really cause for an interesting year, as Clint was just about to go into, and we'll go into in the rest of the interview, that there's a lot of money that is sloshed around the economy, and it's going to cause inflation. You're already paying for this when you pay for it at the pump, you pay for it at the grocery store, okay? But what are your financial goals? What is your income plan look like? And what is your income plan going to look like in a few years when you retire? Are you reaching those financial goals? Do we know what those financial goals are? Have we sat down and developed a concrete plan to take actions to get you to those financial goals? Because I don't want you looking at the news and just worrying about what the world's doing and how it's going to affect you. There's enough worries out there. Don't get me wrong. I can turn on the news just like you and go, holy smokes, this place is wrecking overnight. But the world's been going to hell in a handbasket. The Bible's been writing about it for 3,000 years. So we know that this is going to happen, right? We want you to have peace. We want you to have stability. We want you to be confident in the financial plan that you have. So let's have that conversation. Look forward to seeing you at a dinner really soon, or in an annual review, or on the telephone. I want to talk to you. Take care. Have a great day. See you soon.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.